Well, what's in the value of a word? When it comes to the word provenance, it's everything. It means the history of something. Where did it come from? Who owns it? Where is it now? It's the life story of an item. And in the world of luxury goods, provenance matters. Because you cannot separate the value of an item from its origin and its history. It relates to diamonds, to watches, to art, and to jewellery. But there's a problem. The world's provenance is locked in paper. I get a receipt from the store saying I bought it, I put it in the drawer, and time takes a hold, and if you're anything like me, you forget where you put it. Now, in all this paper, when provenance gets lost, another word emerges: risk. Foundation of our biggest black markets, and the first is theft. In the heart of Hatton Garden, London's Diamond District, this time last year, in Hollywood-style pizzazz, these guys broke into 72 safety deposit boxes, stealing over £200 million worth of jewellery, diamonds, watches and cash. And they did it because they know crime pays when provenance is broken. And then, of course, there's fraud. What's stopping me from calling my insurance company saying something's been lost or stolen, only it hasn't been? I keep it and I pass it on to the next person in 6 months' time. And then there's cyber, a real problem that's washing the shores of every single company in this room today, and it's affecting our own personal security. So these problems are real, they're quantifiable, they cost insurers $50 billion annually, and sadly, they cost every single one of us in this room today with an increased cost of insurance. So we created Everledger. It's a digital global ledger that tracks and protects items of value. And we're on the blockchain because of 4 inherent valuable reasons. First, the records are permanent. The information's entered the system and propagates around the world, and it's encryptographically signed, and it's secure. Let me show you what we did with diamonds. We created relationships with the major certificate houses around the globe: America, India, Israel, Antwerp, where they grade and certify each of the diamonds. Not only did we capture the 4 Cs, but we also captured the laser inscription on the girdle of the stone and 40 metadata points of the diamond with the inclusions internally and wrote it into the blockchain. We created a thumbprint, a digital DNA. We now know where diamonds are being sold and resold on marketplaces such as Amazon and eBay, work with insurance companies on fraudulent claims, Interpol and Europol, who have interest in diamonds that are crossing borders and entering into black markets. We started 12 months ago in the Barclays Accelerator and was made with love from London. And during the last year, we've managed to form relationships with Aviva and work with them in their digital garage in Hoxton Square, sitting amongst some of the brightest minds in the insurance industry, with Allianz in France, in the heart of luxury goods, and of course with Barclays in Africa, exploring the blockchain where the volume of the world's diamonds are still mined today, with BBVA and Commonwealth Bank in Latin America and Spain, where compliance matters. We have, let's round it up, we have 1 million diamonds on the blockchain, with thousands being added daily. We built smart contracts to enable us to track the custody and ownership as diamonds move through the middle part of the pipeline. Through the peak period of Christmas, our system was called on 20,000 APIs at a daily basis, with $2 million suspected in open marketplaces, with 123,000 diamonds analysed as a part of the fraud investigation team. But let me talk to you a little bit about the diamond industry. At the very core of this industry is a chain of trust. It's been around for 150 years, and at the source of that, of course, it's been granting permission and forgiveness since 1888. But what's happening inside of this industry? It's a pretty impressive industry. On the tail end of what comes out of the ground, rough is pulled at $15 billion annually, and as it goes through one iterative manufacturing step, it gets cut to $50 billion, and just before it gets put into a ring and is sold on a retail network, it's $72 to $80 billion in one iterative step. Yet on the backdrop of that, we still have blood diamonds. The atrocity of diamonds is still real. And a part of this technology can help solve one of the last miles of that problem globally. In the middle part of the market, of course, particularly around banks and credit insurance companies. It boasts a $20 billion pocket of credit insurance. And most of the banks that support this industry are Eastern banks, with two very brave Western banks playing in the market. And then, of course, is the problems that we solve. We have fraud, shamefully. It's mostly document tampering. We have issues with synthetics, and synthetics have come into the market. In the 1950s, GE created synthetic diamonds, mostly to support industrial purposes, blades and saws, likely to be the same materials that were used to break into Hatton Garden. But more recently, we've seen actually the onset of those synthetics in gem quality standards, and those gem quality standards are running into the pipeline and are peppering the supply chain. Just recently, we've seen them on open marketplaces and being traded as well. We have conflict stone. 1% of the world's diamonds are still from blood and conflict sources today. And then there's double financing of the pipeline. No recent than October last year, we've seen reports out of India in Surat where double financing has become prolific. The Kimberley process, as I spoke about, came together with 80-odd countries around the world and formed the best Boy Scout promise the world has seen. We reduced blood diamonds by 22% in a short period of time, but most of the officers are armed with a fax machine and an embossing stamp. This technology enables us to provide transparency, a consensus around the authentication and the proof that those stones have truly come from a conflict-free zone. In October last year, DIA, the Gemological Institute of America, the largest, they grade around 70% of the world's diamonds, was hacked. So again, this technology enables us to reduce document tampering, but also assist in the reduction of cyber. And then more recently, November, if you note the date stamp, HRD has invited to the market the ability to remove the laser inscription on the girdle of the stone. Imagine driving around with no number plate. So now, of course, we have the thumbprint. We can still detect where diamonds have moved through the pipeline on Everledger. And then I spoke about synthetics. This is coming into the market at a rapid rate, and it's not actually declining. Just recently, we've had venture capital money pour into the market. There are gem quality standards, and this is an example of one of the facilities that have been built. 200,000 square metre facilities sit in Singapore and China, and they're baking synthetic stones of gem quality standards. How do we detect them? Luckily enough, the industry actually has a controlled environment. And more so, we've actually seen the invocation of controlled devices and connected devices coming onto the pipeline. So now we have a pipeline in the industry with the use of chips such as Intel and other technologies as high-definition photography as a way we can hard handshake from the blockchain to these devices so we can get some assurity around the promise that it is a real diamond. More recently, we've actually extended ourselves beyond the thumbprint, and now we have facial recognition of the diamond, which is pretty exciting. We use high-definition photography as a way to enable us to be able to dig deep within the diamond and see the inclusions and the clouding. We can now take a photograph of that diamond and then match that back to the thumbprint to then check that back against the paper certificate to know if it's real and is the true stone that you purchased or was indeed certified. We're seeing the onset of nanotechnology. Chips are becoming smaller, sensors are on the device. And of course, molecular science will help us get to the last mile in knowing where these diamonds have truly been mined from. So after a year, we have 1 million diamonds. We're pretty excited, but of course, the wave of blockchain is coming and hitting the shores quite rapidly. And I lost a lot of sleep over Christmas. There's no secrets, of course, that this tsunami is washing the shores of insurance, and I'll talk to that at the end of the presentation. But one of the things that I lost sleep over was scale. When I started to think about what goes on in our market, the Antwerp Diamond Exchange trades 80% of the world's diamonds. Rough propagates through there and then gets cut out in India or in Tel Aviv and then moves back to Antwerp. And if we were to support our industry at a very core, I liken the Antwerp Exchange to the New York Stock Exchange. When you think about what New York does, it's 1 billion share transactions a day, which is around 11,500 transactions a second. Yet the Bitcoin blockchain performs at 2 transactions a second. So you can see why I started to get nervous. We needed to scale 5,000 times to be able to support the industry, to be able to go one step further than just identifying fraud. And how could we do that? It's no secret in our industry, the brightest minds are concerned with scale. So we embarked upon a pretty big sort of endeavour over Christmas. We started to see, where will this technology go? We're seeing this hit the shores of property records. We're seeing it in music now, in connected cars. We're seeing also in stock exchanges, in identity, which of course is one of the big wins, and foreign exchange. So if we were to brace upon this, I visualised at Christmas, this is the throughput of the Bitcoin blockchain. And of course, we'd have to probably get to 100 times to be able to cope with PayPal, 1,000 times on Visa, and then the NASDAQ is a pretty scary looking number. So we worked very closely with one of the other startups in Berlin called Ascribe and spent solid 6 months with our head down trying to work out how do we re-engineer a platform to scale. The roadblocks to adoption at an enterprise level for the Bitcoin blockchain, 2 transactions per second isn't enough. 10 minutes is way too slow on latency. Gigabytes is laughable. Scalability decreases as nodes are added, a really big problem. We need about 150 nodes in industry. And of course, the database is not queryable. So if we put down a benchmark of what we truly needed to become the utopic vision and of course the reputation of the diamond industry, we would need around a million writes a second. We needed less than 100 milliseconds on latency, petabytes of data rather than gigabytes. Scalability must increase as nodes are added to the system. And of course, we're talking transparency. We need to see the data. So for those that either are bored with Sudoku or a little bit super nerd, please download the white paper. This is in production. This is very real. We made the announcement in Silicon Valley in February, and of course, we're migrating rapidly across to this platform. You'll be able to pull it up, BigChainDB, it's easy to find. There's a very quick one. The Bitcoin blockchain, of course, has immutability, no central authority, and assets over network. When you think about the power of big data, what does that bring? And if we ended up reversing our mindset and said, oh, instead of trying to scale out the Bitcoin blockchain, what if we blockchainified a big data database? And who's done that before us in today's world? Who's actually gotten to scale? And it's Google and it's Netflix. And so we learned from those guys and then managed to bring to market BigChainDB. It has all of the permissioned capabilities and the querying capabilities that are sensible for our use case and our business case. Of course, we've open sourced it to the Linux Foundation, which is the initiative of everything that's going on in the market, and so rightly should be. And what does our decentralized blockchain stack look like, which is a bit of secret in the source? We have a big IPFS system on our files because, of course, now we're onboarding rapid data around high-definition photography. And then we have the business processing logic system that sits on top with Ethereum, and you heard from Eris yesterday. We proudly have been working with Eris since day one when I came to London last year. And chain and block apps, of course, play an important role in the ecosystem. So that was a bit of super nerd, but let me move straight into kind of where we are now. And we really are here today. It's very real. This year we have some pretty ambitious endeavours, and what does our stack look like, and what does the technology provide for us as Everledger? We've gone from multiple versions of the trust and the truth to one single version of the truth. So we now can see where diamonds are moving across networks. We know where they're being graded and cross-graded. We know where the certificates have been paper-laden and have now actually got a photograph that's different to what's on the certificate. We have inter-transparency across systems. We have batch processing 24 real-time. And of course, our system is no longer vulnerable to hacks. 2016 and beyond, the most important characteristics and enablers for Everledger on the work that we've done over the last year is notarization and timestamping, ownership and transfer title, and the chain of possessions, the movement of goods. But more importantly is the systems of warranties, the source of ethical trade. Blood Diamonds is the vehicle for money laundering. It does still provide one of the largest vehicles for terrorist-funded activities. We have the promise, yet what we're not doing is matching the ethical source and the transportation of these goods to the financial transaction. It is something we're truly empowered with, working with banks to ensure that letters of credit are being afforded to companies of ethical standards, and that those ethical standards are maintained through its process. The catalyst of pipeline possibilities for this technology across broader industry, of course, looks in efficiency, determining exposure, the back office, faster reconciliations. In supply chain, it's around fraud and the detection. It's at bottlenecks. And of course, in exchanges, it's reducing the cost of escrow and reducing the time to transmit across borders. But you probably don't really want to hear about diamonds. Let's talk a little bit about insurance. My background's been 25 years in emerging technology, 10 years in jewellery and insurance in the last 10 years. I've mostly worked, I have a CILA, I have worked in the hands of high net worth and jewellery, and have worked at the claims end of the section. So I know fraud, I understand insurance, and I kind of get where this technology can play. So what's going on? It is washing the shores of industry, particularly in London. We're starting to see Lloyd's embrace this technology in pilot environments. But there's no secrets that we've had 43 banks come together and form as a part of the R3 consortium, and they've done quite an amazing job of not only just building out the technology, but recognising financial use cases. What are we seeing in insurance? What are we doing inside of insurance as well with some of the lead insurance companies? Financial reconciliation is one thing that I think is relatively important and can be used today on the tech stack. Catastrophe bonds is a really exciting part to what can actually be used, and we think about those possibilities. International fronting, B2B2C insurance, of course, is a really interesting play. It might be a little bit far off, but something that should be seriously considered. Smart underwriting, as we start to now see the maturity of the smart contracts platform. It was only last week that we've seen Barclays announce on Monday their smart contract templating platform on the tail end of the efforts over the last 6 months, and it's truly revolutionary. And roadside assistance. I'm not sure why everyone does this, but everyone gives the example of something to do with motor when new technology comes onto the market. So I'll use motor as an example. One of the things is, of course, smart contract and underwriting for car rental or car sharing, where we see things about local parameter inputs on car modelling, rental periods, and of course we have on-demand calculations with algorithms that can enable us to decentralise the algorithm as we have complexities across different customer segments. The benefits, of course, when you think about the consumer, is around a lower insurance price and smoother contracting on the experience. From an insurer's perspective, we have better risk estimations and pricing models. Visa last year, in conjunction with DocuSign, put a smart contract system in the dashboard of a BMW and enacted the entire process from the point of the person getting the keys, sitting in the car, transactional signing on the dashboard, the money was paid for, and they drove off with the motor vehicle, and it GPS enabled the start and the conclusion of the contract. So this is happening. It's happening right today. We work very closely with the leads in industry that are actually building this technology out. I was largely concerned that it would never get out of Starbucks cafes, that it was one of those emerging technologies that maybe just didn't find its home. But what we have seen over the last 12 months is IBM is at the table, and they have now released their platform to market, and they're working heavily inside of open source environment. Intel more recently have produced Sawtooth as a part of their initiatives, and they work mostly in the IoT and connected device spaces. Again, something truly exciting. And R3 brought together the consortium of 42 banks and successfully did that in the first instance, and secondly, they've delivered to market some very interesting, provable transactional flows on this technology. If anyone would like to see me afterwards, I'm here until about 5 o'clock today. I'd be happy to have a conversation with you. Again, we are running some initiation periods with R3 and opening up the experiences out of banking to any of the insurance companies that would like to participate. The shame is that you've got to be in and around London, I guess, or New York. Thank you very much.